Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what's going on in the markets, what we're looking at in our portfolios. As always, please don't use these videos for trading purposes. These are for education only. And we start here with the weekly chart of the S&P 500. Goes back to just the end of 2019 here on the left side. So each one of these candlesticks here represents a week trading. As you can see, we had the 22 bear market, and back here's the 20 COVID sell-off, and now we're getting into a whole new bull market and rallying on to all-time highs in the S&P 500. We've been highlighting for a little bit of time that the terrible market that everybody was looking for last year and what have you in recession hasn't happened yet, and we just keep moving on. So as we follow the markets, we've been in an uptrend here for a little bit, as you can see. We come down here to the daily chart. It gives us a little more detail, and you see some of our moving averages, the 20 and the 50 and the 200 down here. We did have a recent test a little bit lower here in April, but nothing really to speak of. Came down to support that we were kind of highlighting there, and bounced off of it, and now again on to another rally, and we're very, very close here today to all-time highs that we did hit just about a week or so ago. But everything from the weekly charts and the daily charts here, all of our long-term charts are absolutely looking like we're in an uptrend here, so nothing to be concerned about just yet. We come over here to the 2-hour chart. This gives us things in a little more detail, and this gives us about the last 6 months trading. And you can see here for the start of the year, we had a nice little rally through April, had a little test lower, and now just moving on to all-time highs we're testing here, and certainly looking like we're going to hit that as the channel has turned higher. So right now, really not anything to any reason to not be invested in this market. If you're paying attention to what the markets are saying, they're saying go. And if we go down here and look at some of the internal measures, this is a little bit more of a concern. As you can see here, this is the percentage of the S&P 500 that's in an uptrend. And normally, if you look back here on the left side, you might see, like in December, you might have 81% of the market in an uptrend. Currently, we're at 57, even though we're hitting all-time highs. So that is a little bit concerning, even though it turned up in recent days, not as much. So we are seeing a market that is getting really boosted by a handful of stocks here. But again, the major trends are showing that, hey, we're still going up. And even though the breadth, as they call it, is concerning, that it's really being driven by just a small number of stocks rather than the overall broad market. We come down here to the advanced decline line on the New York Stock Exchange. You can see it's been mostly flat here, but really money not pouring out of that, even though some of these stocks are declining, and why they're not all in an uptrend. They're not exactly going down either. It's more of a sideways action. If we go to the bottom here, this is the VIX, the volatility index, and you can see that's at about 12. So this is usually when people are paying extra for options to protect their portfolios. You'll see it spike, as you did here in April when the market started going down. Well, now it's really plumbing the lows. So really not seeing a whole lot of problems there. Certainly not with these two. A little bit on the bullish percent, that only 2/3 of the market's in an uptrend as we're hitting an all-time high. But something to keep our eye on. But until it turns some of the major trends, larger trends, stay invested in the market for the time being. We look at the culprit, as I've been saying for quite some time. This is the interest rate on the 10-year Treasury, U.S. Treasury. And really, as you see here, 22, we got in the bear market because interest rates were rising as the Federal Reserve was raising rates. That can tend to cut off the market a little bit. And it actually has flattened or has stayed in the same range, around 4% here for the last year and a half. But in recent days, you see it had started rising through that April period where we had a recent test lower. And now, as it's lower in the stock market, now as the interest rates are starting to fall a little bit for the last week or so, now we're starting to see the rally pick up and hit all-time highs. So I think this doesn't always happen this way, but right now the interest rates and the stock market seem to be very well entwined. And as these rates are falling, I think you continue to see the market go higher and go on to all-time highs. If we come here to hide these the controls here. If we come here to the economic picture, the GDP growth rate previous had been 3.4. Here we're going down to 1.3, so a little bit lower, a little bit of concern, but still not recessionary yet. Same with non-farm payrolls. The jobs number still very positive, even though it's fallen from its last look. Inflation still mid threes, not where the Fed wants it to be, and can leave some concerns that maybe the Fed won't be done or won't lower rates anytime soon. But again, these are not terrible numbers, not what we were looking at a year and a half ago in the 8, 9, 10% sort of figures. And then we come here to retail sales again, a little bit concerning there. They had been positive, they're down to about zero. So I'm not going to argue with the people who say that recession is coming at some point, but until I really see it and I see the market start to react to it, I'm not going to try to guess the timing of that. And then if we come here to the earnings estimate, the forward earnings estimate for the S&P 500. So this is analysts' guess of where earnings are going to be on the S&P 500 going forward. And this is out to the fourth quarter of next year. They're still showing that we're going to have really good earnings there. So not a whole ton to tell me, hey, look out. Certainly a couple of things that are concerning, but I'm not seeing anything glaring. And finally, I highlighted this in the last video, the valuation. If we go to 38.48 here, that's 20 times earnings. It's probably somewhere where the S&P should be comfortable. And if you look here, we're up way past it. So anyone who says the market's not expensive, I mean, earnings could go much higher and sort of catch it up. But right now, yes, the market is very expensive. So again, not a timing tool. You've gotten parts or markets in the past where we get to, hey, the market's really expensive, and then can take years to correct that thing. But it's just something to keep in mind that the market is very expensive now. So for the time being here, again, if you look at the biggest picture chart here, we're in an uptrend and not seeing too much of great concern going forward. So just try to stay invested and see what happens there, and just be ready that if it does turn, if that overvaluation does catch, or interest rates do go the other way, or the economic picture, the jobs numbers and such, then it might be some time to use some caution, but we're not quite seeing that yet. So hope this was helpful and informative. I'm going to put up a let's see if I can find our contact information here. Nope, I don't have it for this time, but anyway, I'll put up here our website, and it has, and we do have these videos on the website, so you can always call at this number or hit us at that email address if you'd like to hear more about what we're doing in our portfolios. Anyway, again, hope this was informative and helpful, and we will, thanks for watching, and we'll see you at the next update. Thanks so much.